We don't need to see my face doing all this shit. So the basics, before everything we do here, if you want to go walk through with me with everything I'm be showing, you need to make a TradingView account. TradingView is the account that you trade on, or the software that you'll be trading on. So you just look up tradingview.com. It would be right here. TradingView desktop. You can put it on your desktop if you want. But this is what most people use to trade. Okay. So please make an account for TradingView, then everything else gonna come with then you'll be able to follow me step by step with everything I show you. Alright. So after that. So after you make your account on TradingView, you will see many stocks. The top 4 stocks that you want to look at, or the top 3 stocks, would be NASDAQ, NQ, S&P 500, and Dow Jones. These 3 stocks is our future stocks, right? You could trade other stocks as well. You could trade metals, gold. People trade gold and make money from it. You could trade forex. I don't trade forex. I won't be showing you forex, but everything that I teach within this stream will be able to be taught on everything else. So if you want to trade gold, you want to trade silver, you want to trade forex, everything in this stream will be able to be used in all areas of trading. So that's what's going to be good about this stream. All right. So your top 3 will be S&P, Dow, and NQ. And to add these to your watch list, NQ will be right here. Then MNQ is this one. MNQ is the one that I want you to add to your symbols. MNQ is for learning how to trade. It's micros. Micros, you make less money, but you have more leverage. Where NQ, you will make more money because it's minis, but you're gonna lose more as well. So I don't want you to have these funded accounts or trying to get a funded account and trying to trade NQ because you only have a $2,000 drawdown. All right. One mini or NQ, $10 will equal $1,000, right? But that also, if you lose $10 on your trade, you lose $1,000. While as MNQ, one mini, if you make $10, you probably make what, $20. You see the difference? That's why you trade MNQ first. You always trade the micros of everything. MES is the micro of S&P. So as soon as you start, you trade micros to build up your money. Then when you have enough money in your account to trade minis, that's when you go to the real big dogs. All right. So let's show you a chart. My bad for my chart. These are the charts I use every day. Let's see. Okay, the one that I'm showcasing now will be MNQ. I'm gonna get all this bullshit out this. I'm gonna get all this off the screen for y'all, so y'all know what I'm looking at. What is that doctor in this thing? Canvas. The black. I fuck with black. Okay, today we'll be looking at NQ. And the first thing week one is all about learning NQ, NNQ, QQQ, and ES. Learn candlestick support and resistance. All right. So the most straightforward thing I could tell you about candlesticks, the green ones means it's going up. You're buying. You're taking longs. So if you take a buy trade up top, if you buy the market, you will want to see the market go up with green candles. If you sell the market, you don't want to see red candles. Red candles means they're selling, bears, put options, etc. It's a many ways to put it. Okay. The read candlesticks is very easy as well. We'll go through that after we go through market structure. All right, market only moves in two ways, up and down. And the easy way to see that is if you go up top on Tradingview and you press on the line option, this is what you see. The market will go up, down, up, down, up, down, up. Then it will break trend and start going down. Okay. All in all, the market will always go up, as you can see. So you could say, if I swing my buys, swing basically means you trade for a longer period of time. Day trading, you trade day by day, while swing trading, you trade for months and months. So you swing trade all your trades, you'll be able to make money, but day trading is where you make the most money at the smallest amount of time. So the market only moves in two ways, up and down, and you can see it within these lines. And you only have two trends. You have your longs and your sells. All right. Let's see. So let me show you this. So one, this would be a long market, a market that's buying. As you can see right here, what is going on is we're making higher highs and lower lows. So we have a high here, it passed that, break structure. We have a high here, and it's gonna keep going like this, right? So this is what you want to see in a buying market. You want to see this. It's gonna pull back and keep going up. So when the market is moving like this, all you want to do is press your buy button, okay? Don't go against trend. If the market is long, you go long, okay? On the opposite end of that, if the market is bearish or everyone is selling, like right here, the market look like this where it's a lower high, lower low, lower high, lower low, lower high, lower low. You will want to sell, okay? Do not push a buy button. The key thing is never go against trend. If you go against trend, it's for these short-term pullbacks, okay? Because the market will never do this, right? You will never see the market do this right here, okay? The market would never move in a straight line. So this is what the real market will look like at all times. You will have a high put in, then a lower low, and a high and a low. So if we're bearish, what you want to see is boom, 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 boom for shorts. Simple enough, right? A long market will look like this. Highs will get taken out, a low will get put, highs will get taken out, a low will get put, highs will get taken out. Where a bearish market will look like this. lower high would get set, lows would get taken out here, high would be set, a lower high would be set, then lows would be taken out again right here. All right. But markets can shift, right? You could go from a buying trend to a selling trend, okay? And what that basically means is, say if, let me take this off the screen. Say if right now we're buying, this our market moving, but we're not able to close past this high right here, this higher high. What will happen is, if we break structure, breaking structure basically means this low right here, I'm gonna put in yellow. If we break past this low right here, and we're not able to move back up past this high right here, we're moving down to the downside now. Okay, and this how the market works. We'll move up, down, up into some liquidity, down, up. We can't get back past this high, so we're either going to chop within this area within here, or we're going to break structure to the downside after passing this low, then coming back up to pull back up a little bit into a FEG or something, some sort, then keep going back down to grab some more liquidity. I'm gonna go through liquidity as well, but right now we're just talking about lines, market structure, okay? So at the start, this is all it is. If you could look at this, you'd be like, up goes up, down go down, then we're good. So let's move on to the next one. And putting the more introspect for you. I just want to make sure this is like the easiest shit I can make. Cause this is by far, this is the easiest. Trading is the easiest shit ever. I'm gonna label this shit out for y'all as well. Okay. Okay, so in an up market, what will happen is you will take some liquidity or some sort at these bottoms and you will make a high, right? So you make a high here and this is your lower low. So what you don't want to see is market take back. So if we have a low where it comes all the way down here, then that means the market is still bearish. But that's a talk for later. In an uptrend, this is what you want to see. Higher high, lower low. Higher high, lower low. Higher high, lower low. That's all you want to see. You want to just keep, you want to see a pullback going higher. Pullback, go higher. Okay? Simple enough. Then for a downtrend, this is what you want to see. So a high is set. We're not able to get past this high, so we go lower. So we have a higher low, lower low, higher low, lower low, higher low, lower low. And it keeps going on and on and on. All right. Then those are the two trends. You go up then you go down. That's all it is to it. If you look on here, we go higher high, lower low, higher high, lower low, higher high, lower low, higher high, lower, higher high. And that's the uptrend. And this is on a real chart. Then down here, now we're on a downtrend where it's higher highs. You go low, like I told you before. We passed this low, which means we're now in a downtrend to the downside. Downtrend starts. So we go back up. We're unable to pass this high here. So this high would now be resistance. And what happens? Higher low, lower low. Higher, higher, higher low, lower low. Higher low, lower low. And therefore they're fourth, right? And that's how the market moves. Alright? Simple enough. So now that we got market structure down, market only moves two ways. Up in the uptrend and down in the downtrend. Let's show you how to read candles. The easiest thing to me is how to read a candle. Let me make sure we're in trend, range, breaker structure, change of character. Cool. Alright, cool. So now we're going to learn about times and time frames, and I'm going to tell you about breaker structures as well. So like we just went through uptrends and lower trends, now we're going to go through what a breaker structure is. So a breaker structure is when a uptrend turns to a downtrend. Oh. God damn. Did I go to school? Turn to a downtrend. Uptrend turns to a downtrend, and you reverse it when a downtrend turns to an uptrend. And when you can see this, it's easy, right? Let's see. I'm gonna do the same thing with the path thing, right? Right now we're in a downtrend. Let me go a little bit farther down. Let's see. So I can find something good. Alright, boom. Right here. Was this last? Oh, this is March. Okay, cool. So now we're in a downtrend, right? You see on the market how I can tell we're in a downtrend. Watch this. We go up to make a higher high, but we go down. Okay. Then we go up. Then we make a lower low. We're unable to pass that high right there to make a higher high. We go down, up, down to make a lower low. So without all this, so I don't confuse this how we're gonna look really. Boom, boom, make a lower low, tap it, boom. So this is a downtrend. A downtrend does not get broken until this high right here, the last high that was set, marked right here. The last high that was set right here. When this high get broken above, that's when we're on the uptrend, as you can see now. So what happened is we were on a downtrend. We push up, break past this high right here. We broke structure to the upside. And now we're going up, down, boom. And now we're in an uptrend. And that's how the market moves. You will go down, break structures to the upside, go back up. Like, it's very simple. Very simple. things. We go down, then without the chart, let me show y'all this without the chart as well. This how it will look. For a downtrend to turn to an uptrend, we're gonna go boom, lower high, higher low, lower low, higher low, lower low, boom. So this is gonna be the reverse. We come up, can't break past that, but we're also not breaking past that lower low. So we're gonna move up, boom. So once we break past this high right here, that was set way before, within the downtrend, that is our breaker structure to the upside. Very simple, very simple. Then once we add liquidity and all this other stuff to it, you will see how easy this gets. All right. So how do we break structure to the downside? It's easy as well. Higher high, higher low, higher high, higher low, higher high. Boom. We're not able to make a higher high here. So now this high right here turns to resistance. Okay. We're not able to break above. So what happens? We go lower. And once we pass this low right here, it turns into a breaker structure to the downside. So now we have lower high, higher low, lower high, higher low. Simple. Okay. So so let's get into everything else. So now that I show y'all market structure and how market moves, I'm gonna show y'all the daily time frames. Okay. Your best frames will be the daily. This is the first time frame. This will show you the market structure for you will use the daily for your bias. Your bias is gonna be if you're gonna go long or short. If you're gonna buy the market or you're gonna sell the market. Okay. So before you do anything, every day at before 9:30, you will go to your daily, see what's going on. Then you're gonna scroll down to your 4 hour. Your 4 hour will show you FVGs, etc. I'm gonna go through that as well. Your 4 hour will help you see where you want to take your trade. Then you'll go down to your 1 hour, then your 15. Then eventually you're gonna get to your 1 minute. Okay. Simple as that. Your 1 minute is where you're gonna find your entry, okay? If you're, let me say this. Most people they find a entry on the 1 minute, but you might be if you're an aggressive person in real life, right? If you're like say like say like when you play COD or you play games, you're a Russian person, like you get kills, then you're a scalper, okay? That means you want to trade fast and get money quick. Whereas if you're patient in real life, you're gonna be taking more better trades. But either or you can make money from. I know there's a girl on YouTube right now. I think her name is Aaliyah. She makes 3 to 4K a day just scalping. While as you have your long-term traders like ICT, TJR, they actually try to find their trading entry first. Then they go into it and they can make 20K off one trade. Whereas a scalper would try to make 20K off of 10 trades. Okay, it's a difference to it. I'm gonna show y'all both of those as well. All right. So time frames is better. It's very easy to understand. Use your daily to find your bias for the day. See if it's gonna be if you're buying or selling. Then use your 4 hour to find any confluences. Then you go down to the 15 minute to find anything that you like on the market. Then you go to your 1 minute to find your entry. That's all it is. All right. Learn support and resistance. All right, so this is one of the easiest trading strategies I can show y'all. Support and resistance. All right, so support is basically areas in the market where price bounce off of, and resistance is areas that price reject. Okay. Some people only trade support and resistance. I will show you why. So on the daily, right? Support area would be boom. This right here. Okay. Because as you can see with these candlesticks, we're bouncing off of these candlesticks. But before I go into that, I forgot. Let me show y'all how to read a candlestick. Okay. Where's the drawing tool? This shit's easy. Okay, let me single out just one of these candlesticks real quick. Okay. So to read a candlestick, right? The body is where price is, and the wicks is where price was, okay? So if the market is buying, you want to see this big green candle up, then you see price is these wicks. So with a FVG, right? A FVG is a fair value gap. And a fair value gap is between three candles, right? So you have your one here, your candle here, 1, 2, 3. So the FVG is the FVG is the space between three candles. So what you want to do is right here, okay? And that's the FVG. What a fair value gap is, fair value gaps is places where market will eventually come back to, okay? So let me show you an example of what of FUG not is. Okay, so you have your three candles, 1, 2, 3. It's no gap within here. But there's a gap within here. Okay, so this is your FUG. And how you could use this FUG is FUG is where it would tap into here, right? We have a tap here, or first of all, let me say this. This is a bearish FUG, so what you would like to see in a bearish FUG is price taps into the FUG and keep going back down. And that's what you see here. So if I go to the hourly, right, what happened is it moves all the way back up, taps right here, and go back down 200 points. And that's a bearish FUG. A bullish FUG is which is exactly the same thing, right? So this would be a bullish FUG. We have your three candles, 1, 2, 3. You'll line it up to the wick of that third candle to the top wick of that first candle. And you see that price comes to the 50% line, bounces, come back and bounces. As long as this don't happen, see. As long as this don't happen in the FUG, where price just inverse the FUG, then it's a fair value gap. Okay. Now also, what you could call this support, because like I said before, a support line is somewhere where price taps and bounces off of. Price is tapping the 50% of the FEG and bouncing off of it to reach higher. Simple enough. Resistance is easy to find as well. Your resistance area on this chart is right here. Okay. Why is this resistance? If you look at it, price is tapping right here. See the candles, the wicks, if the candle body can't close past this line, then it's resistance. But if a wick pushes up like it did, this one right here pushes up, this wick pushes up all the way up here, but it drops all the way down, that doesn't matter, right? If the body can't close above this line, then it's resistance. Price is tapping this line and rejecting to the downside. Tap, reject, tap, reject. That's your resistance. It's the same thing, right? Here's your support. This is bad support. Let me see. This would be your support down here. Price tap off this twice and bounces back up to try to break through resistance. So what you can do with support and resistance is where if price breaks above this resistance line, taps back, boom. That's your trade right here. You wait for it, break above this line, tap back into the line, and keep going higher for higher profits. Then for support, what you'll want to see is boom. Market rejects off resistance, come back down, breaks past, tap the support line, and keep going down. And it once it taps, that's your trade to your downside. Simple enough. All right, support and resistance is done. Change your character to just like break the structure. Learn trends. Alright, show y'all trends. Mark 4-hour, 1-hour levels. Alright, so now I'm going to show you liquidity and marking out levels. FEGs, order block setups, all in real time. So on your Tradingview, if you're on it, you will press the replay button. And we're going to pick, what was a good day? What was a good day? What was a good day? Alright, I'm going to show y'all the straight breakdown of how you do this. Okay. Using everything that I just said. Hopefully things make sense. So we're going to use, what was a good day? We're going to do this day right here. June 9th. Boom. Let me make sure everything's good. Also, the market is open for 24 hours. Let me make this clear. The market is open for 24 hours. It's 3 different sessions. It's your Asia session, which is 6 p.m. to 2 a.m. That would be your slowest session. But people like trading Asia because you get cleaner setups. You have your London session, which is 3 a.m. to 11 a.m. Then you have your New York session, which is 9:30 to 5 p.m. I trade New York because that's where all the real liquidity and all the real moves be at. Let me see everything's good. Electronic trade hours, boom. Let me fast forward a little bit. Okay, it's 8:55. So the first thing you would do is find your bias. So you go to your daily time frame, see what's going on. We have support in this area that we just bounced off of Monday. Monday we bounced off the support.